let's go and look at the option building blocks. So these are calls and puts. So if you're doing something like a spread, an iron condor, or butterfly, and if you don't know what these things are, those are basically just ways of structuring trades with options contracts. Now the fundamental pieces of these are calls and puts. So a call option is a financial contract between a buyer and a seller, giving the buyer the right or the option to buy the underlying asset at the agreed upon price, which is called the strike price. We'll get into that here in a minute, within a specified time. The buyer of the call option benefits when the upward movement in price of the underlying asset. A call option is a fixed risk strategy, meaning the cost of the option at the time of purchase is the max risk to the buyer. So I touched on that just a second ago. Basically what that means is if you're buying a call option, you're hoping that whatever it is, so if you're buying Apple call options, you'd be hoping that, over whatever period of time, so with an options contract has varying amounts of time. You may be buying weeklies, where you only have, a couple of days, or you might be buying 30 to 60 days out, whatever it is. And so basically if you're buying calls, you're looking for the stock to move up. And the way I sort of learned this, just an easy way to think about this is if you're getting a phone call, you're going to pick the phone up, so upward momentum. So this is a bullish type of position if you're buying calls. Now, kind of in the inverse, if you were selling calls, I don't want to confuse people who may be new to that kind of concept, but if you're selling calls, that's obviously, or that would be a bearish type play. Now, this is an option chain here, so we'll get more into what the option chain is in a little bit. But you can see over here on the left with the yellow arrow and now the pink arrow, you see these are our calls. And at the money would be basically right now. So at the time, let's see, Apple was trading at 219.31. So the at the money would basically be like the 220 strike. So the at the money would be these here. And, for 700, actually, so about 750 is what, you could get an at the money Apple contract. So those were 27 days out. So we're going to talk about the opposite side of that now with put options. A put option is a financial contract between a buyer and seller, just like the call option, and basically, really without kind of reading you the definition, it's basically the opposite of a call. So a put option takes advantage of downward movement, so it's a bearish type play, as you can see with the nice little wooden bear we have here. Basically, with in the case of Apple, once again, if you're buying put options, you'd be looking for Apple to move lower. Now, very much like the call options, you'll see over here on the right-hand side of the option chain, you'll have your puts, and here are your different put options. So these are the different strikes, so we'll get more into that in just a second here.